Okay, let's dive into this one. Guardforce AI, the ticker is GFAI.
Right.
And this company, it's going through a really interesting transformation.
Hmm.
Historically, they were all about secure logistics, think cash handling, ATM services,
Mm.
the kind of foundational stuff. Keeps things moving, but maybe not super exciting growth-wise.
Exactly, the bedrock. Necessary work, yeah, but traditionally kind of low margin, slow growth.
Right.
Yeah.
But now they're trying to become something totally different, a player in AI-driven robotics.
Why to pivot?
It's a huge pivot. And you can really see the market reacting. That stock price volatility between January and early June 2025, it swung from like 0.76 all the way up to $3.88.
Wow.
And now, well, early June 25, it's sitting around $1.17.
Yeah, that kind of movement in just a few months. It tells you a lot about the uncertainty, but also the excitement around this shift.
Yeah.
There's definitely a speculative element there.
Absolutely. So our mission today, we've got this stack of sources covering January to early June 2025. And we're going deep on Guardforce AI. That's NASDAQ GFAI, looking at it from, let's say, a value investing angle.
Okay.
We want to unpack what these documents tell us about this whole business transition, what management's up to, the financials, where they stand in the market, who owns the stock, and, crucially, the risks involved. We're digging for the key insights here.
And, if you find this kind of deep dive analysis valuable, you should really check out the Stock Analytics AI YouTube channel.
Oh, definitely.
Give them a like, subscribe. They do analyses just like this one.
Yeah, it's a great resource. Seriously, check it out. And for just, what is it, 4.99 euros a month, members can actually give them a ticker symbol.
Yeah.
And get a prioritized deep dive just like this, often right after earnings calls, too. So it's super timely.
Mm-hmm. And listen, as we go through GFAI's story today, keep one thing sort of in the back of your mind. This company, it faces some pretty big challenges making this whole pivot work. We're actually going to reveal what we think is the single most critical factor, the biggest hurdle they have to clear right at the very end.
Ooh, okay. A little tease. Definitely stay tuned for that. And while you're waiting, if you like what you're hearing, make sure you subscribe wherever you're listening. Don't miss out on future deep dives.
All right.
Okay, let's get started. First things first, laying the foundation. What does Guardforce AI actually do now, and how are they trying to make money?
Well, the sources talk about a dual business model, and that's really key to understand the whole thing.
Right. So on one side, you still got the established business, secured logistics. That's their history, right?
Mm-hmm.
Cash in transit, managing ATMs, processing cash.
The old guard.
Yeah. And in 2024, that still brought in most of the money, $32.4 million. But it only grew like 1.7%. Tells you it's stable, reliable maybe, but not where the growth story is.
No, definitely not. The exciting part, but also the much smaller and less proven side, is robotic AI solutions.
Right, yes, right.
Robot as a service.
Exactly. They're developing and deploying actual physical robots for things like thermal screening, disinfection, security patrols, deliveries.
Okay.
Plus AI software, too, like that DVGO travel planning tool. They mentioned having over 1,000 of those robo-travel agent units out in the Asia-Pacific region.
And the strategy seems clear. Lean into the AI side, push for these higher margin offerings. That's where they're focusing the growth efforts. They've apparently grown their retail client base quite a bit, over 25,000 stores globally now. And even within the old logistics part, things aimed at retail clients, like their Guardforce digital machine or GDM revenue there jumped almost 40% in 2024.
Yeah, and this shift towards AI, it presents the big opportunity, right? Can they leverage that existing logistics client base, that retail network, to sell these new AI services, create some synergy?
That's the potential upside.
Yeah.
But the challenge, the risk is, are they spreading themselves too thin? Trying to manage the stable, slow legacy business while pouring money into this capital-intensive, still kind of unproven AI venture.
Makes sense.
R&D spending did go up significantly in 2024 to like $591,000 from $170K. But, is that really enough when you look at the range of AI products they're talking about?
Yeah, that's a really good point. That list is long patrol robots, disinfection bots, travel agents, AI advertising, hotel stuff, food delivery. Can $591K in R&D realistically develop cutting-edge tech across all of that?
It feels like a stretch, doesn't it? It raises that risk of maybe not doing any single thing exceptionally well because they're trying to do everything.
Yeah, diluting the effort. So where do they stand in the market?
Primarily operating in Asia-Pacific, Hong Kong, mainland China, Thailand. They had that established presence, the retail connection.
That they're small.
Very small. Microcap, right? Market cap around $24 million, FY24 revenue $36.3 million. They're tiny compared to the big global tech or robotics companies.
So their strategy has to be leveraging that regional know-how, those existing relationships, rather than trying to compete on sheer scale globally.
That seems to be the play. Their stated value proposition is basically combining cutting-edge robotic AI with their sophisticated cash handling to offer, quote, comprehensive integrated security solutions.
Okay.
For the AI part, it's about making clients more efficient, boosting sales, especially in retail and travel.
And the hope is that this blend, the mix of physical security and AI, is their unique selling point, their moat.
That's the idea. If they can actually integrate AI insights or robot efficiency directly into the services they already provide clients, offer a smarter tech-enabled security or operations package, that could be really powerful.
If they can pull it off.
Big if. The sources are pretty clear. The execution is still largely unproven.
Okay, so quick recap on the business. They're trying to shift from mainly being a secure logistics company, making money the old way, which is still most of their revenue, to becoming more of an AI company, aiming for robot as a service and software revenue, higher margins, especially using that retail network.
Exactly. The transition is the whole story here.
Which naturally leads us to the management team. CEO Lei, or Olivia Wang, is leading the charge. FY 2024 was called transformative under her.
Yeah, and the sources point to some key achievements, reported ones anyway, for that year. Gross profit up 16.1%, gross margin improved to 17.2%.
That's positive.
A big drop in SG&A costs, down almost 21%. And the headline number, narrowing that net loss by over 80% down to $5.9 million. That's compared to $30 million the year before.
Okay, cutting the loss that much is definitely significant. But the insight here seems to be it was mostly driven by cutting costs and improving margins, right? Not really by massive growth from the new AI stuff yet.
That seems to be the case. So the real test for management now is, can they actually generate sustainable top-line growth, specifically from AI? Their stated 2025 goals, strengthening logistics, expanding retail, investing in AI, going global, they all point towards needing that growth.
Right, and the sources don't really detail management's track record in scaling high-tech AI specifically, do they? It's kind of a new game for them.
Not really, no. They did appoint a head of R&D, which is a good sign. Shows they're trying to build that expertise.
Looking back, they had some rough years before 2024. Big losses, $19 million in 22, $30 million in 23. How did they handle that?
Well, this strategic refocus, the aggressive cost-cutting, the big push into AI, that's presented as the direct response to those losses.
Okay.
The restructuring in 23-24 suggests management can make tough decisions when needed. That's important for a turnaround attempt.
And how open are they being about all this? Transparency.
They do the standard stuff, earnings calls, webcasts, press releases, But for investors trying to track this transformation, the critical thing they need is more detail on the AI business itself. Segment-specific stuff, like how fast is AI revenue actually growing? What are the adoption rates? How much money are they making per robot deployed?
Gotcha. Granular data.
Exactly. And the sources say that kind of detail is not yet apparent. That's a big gap for investors trying to figure out if this strategy is actually working.
What about ethical reputation? Anything in the sources?
Nothing specific, no major red flags or commendations mentioned in what we have. They talk about having a trusted brand name for over 40 years in their traditional business, which implies, general adherence to standards. But it's based only on these docs.
Okay, so the key management questions. Are they honest, capable, and focused on shareholders?
Honesty seems standard based on communications. The 2024 results, assuming they're accurate reflections of operations, suggest credible reporting.
Capability.
Well, they've shown they can cut costs and set a new strategy.
Yeah.
The big question mark is execution on the AI side. Can they actually scale that complex business and make it profitable long-term? The direction's clear. Execution is the uncertainty.
And shareholder focus.
CEO Lai Wang owning over 5% of the stock. That's a decent stake. Around $1.28 million. That aligns her interests.
Yeah.
And focusing on higher margins, getting back to profitability, that's definitely shareholder-friendly. Of course, the past losses hurt shareholders, no doubt, but the current efforts seem focused on building future value. The main uncertainty remains that execution capability.
All right, let's pivot to the financials then. The numbers really tell the tale of a company in flux.
They really do. You see improvements in costs, margins are getting better.
Yeah.
But the big picture is still stagnant overall revenue, combined with ongoing losses, even if those losses are smaller now.
Okay, key numbers from FY 2024, early June 2025. Market cap is tiny, around $24 million. That just screams microcap, right? High risk, high potential reward, maybe?
Definitely. And price to earnings is negative, obviously, because they're losing money. But interestingly, there's a forward PE estimate, non-GAAP, around 10.5. That suggests analysts are expecting them to become profitable down the road.
But here's the number that jumps out, highlighting the challenge: revenue growth. It's been basically flat for 5 years, only up 0.2% in FY 2024 to $36.3 million.
Yeah, that flat revenue line is the core financial problem right now.
Hmm.
It really shows that whatever growth they're getting from AI, it's just not big enough yet to, offset declines elsewhere or really move the needle for the whole company. The AI pivot is still very early days in terms of making money.
Okay, but profit margins did improve, you said.
Yes. Gross margin went up to 17.2% in FY24 from 14.9%. That gave them about $6.3 million in gross profit. That's a positive sign, better cost control, maybe a slightly better mix of services.
Roll butts.
Operating expenses are still eating that up.
Mhm.
SG&A was $10.1 million. R&D was almost $600K, so over $10 million in operating costs. That wiped out the gross profit and led to the operating loss and the net loss of $5.9 million.
So the takeaway is they got more efficient on costs, but operating expenses are just too high for the current revenue. They need way more growth or deeper cuts.
Pretty much. They need one or the other, or likely a combination, to get into the black.
What about debt? Are they swimming in it?
Actually, no. It seems relatively healthy there. Debt-to-equity ratio is moderate, around 0.4 for total liabilities to equity, and actual interest-bearing debt is really low, like $262,000. Almost nothing.
Okay, so they're not under pressure from lenders.
No, the financial pressure is coming from the operational losses and just needing the cash to fund this AI transition, not from servicing debt.
And free cash flow, probably negative.
Yeah, as you'd expect for a loss-making company. It's constrained, likely negative in 2024. One source estimated around negative $3.3 million in operating cash flow. They're not generating cash consistently from the business itself.
But they have cash on hand, right? A buffer.
Yes, crucially, yes. They ended 2024 with $23.4 million in cash and equivalents. That's their lifeline, their runway.
How fast they burn through that is key then.
Absolutely critical. The good news, though, is their adjusted EBITDA improved a lot to negative $0.7 million in 2024, from negative $1.8 million the year before. That suggests the cash burn from operations is slowing down.
Okay. And one last metric, price to book. You mentioned it was low.
Yeah, around 0.6 to 0.7 in early June 2025.
Which can sometimes mean cheap.
Sometimes. A PB below 1.0 can signal a stock is statistically cheap relative to its assets. You see it in turnarounds or asset-heavy industries. But, and this is a big but for a company that isn't profitable,
Yeah.
PB doesn't tell you much about real value unless you believe those assets can start generating profits soon. You have to weigh that low PB against the history of losses and the fact that the AI strategy just isn't proven yet.
Got it. So, summing up the financials, losses have been consistent, though the amount varies. No major debt problem. The real story is cost control buying them time, funded by their cash reserves, while they bet big on this unproven AI revenue pivot.
Well summarized.
Okay, that covers the internal picture. Let's switch gears to the outside view. How's the market feeling about Guardforce AI right now? Market sentiment.
It seems pretty mixed, actually. There was definitely a waves of positivity after those 2024 results came out, showing the smaller loss. People were talking about major financial turnaround.
Right.
And we saw a short interest drop, too, by almost 6% around April 2025. Suggests some bearish bets were being closed.
But that positive vibe hasn't fully stuck. The stock price is still pretty low.
Exactly. Some commentary suggests the shares are lagging because of that persistent weak revenue growth. The market seems to be saying, okay, cutting costs is good, but show us the growth.
So sentiment gets boosted by AI news or cost cuts, but the flat revenue is like an anchor, keeping a lid on things long term.
That feels right. It makes the stock really susceptible to news flow, Good announcement, it pops. Quiet period, it drifts. Not driven by deep conviction yet.
What about the analysts who cover the stock?
Well, there aren't many, which is typical for a microcap. But the ones who do cover it are surprisingly bullish.
Really?
Yeah, strong buy consensus. The average one-year price target is way up there, like $4.50 to $4.59 range. Compare that to the current price around $1.17. Big names mentioned include E.F. Hutton, D. Boral Capital, with buy or strong buy ratings.
Wow, that's a huge gap between the current price and those targets.
It is, and it shows the kind of upside these analysts see if the whole AI pivot actually works out. But, crucial context.
Yeah.
It's a small number of analysts.
Right.
Their views might not reflect the broader market, and you always have to consider potential conflicts, or other relationships these firms might have.
And recent news driving sentiment has mostly been those FY 2024 results and any AI updates.
Primarily, yes.
Yeah.
The smaller loss, the better margins, talk about retail expansion, any news on the AI products.
Yeah.
That's what's caused the recent positive blips.
And the short interest, still relatively low.
Yeah, fairly low. Around 3.7% of the float in early June, low days to cover. That recent drop suggests bearish conviction isn't particularly strong right now. Maybe a wait-and-see attitude from the shorts.
Okay, let's look at who actually owns GFAI stock.
This is interesting. Institutional ownership is very, very low.
Like how low?
Around 2% of the outstanding shares held by known institutions in early June. Maybe 14 owners total. Even big names listed, like Renaissance Tech or Morgan Stanley. They only hold tiny, almost negligible positions.
So the big money, the institutions, they're not really involved yet.
No, basically GFAI is off the radar for most of the institutional world. If the AI strategy starts showing real results, seeing institutions build positions would be a significant positive sign, but they're not there yet.
What about insiders, the people running the company?
CEO Li Wang owns just over 5%, which we mentioned aligns her interest. However, there's a potential discrepancy in the sources. One source suggests total insider ownership is much, much higher, like 76.70%.
76%, that's huge.
It is. If that number is accurate, it means ownership is incredibly concentrated among insiders.
And what does that imply?
Well, a few things. If insiders own over 3/4 of the company, the actual public float the shares available for trading by you and me becomes very small. Maybe only around 4 million shares out of nearly 18 million outstanding.
So low float means high volatility.
Exactly. Small amounts of buying or selling can cause really big price swings. It makes the stock potentially much riskier, especially for retail investors. It also makes you wonder who these other large insider holders are and what their intentions are, from a governance standpoint.
Right. The sources didn't mention any recent insider buys or sells.
No, nothing recent noted, which is kind of neutral information.
So the ownership picture is potentially very high insider concentration, very low institutional ownership, meaning retail investors likely make up a big chunk of that small trading float.
That seems to be the likely structure, yes.
Yes.
High insider ownership could mean they strongly believe in the company's future. Or it could raise governance flags and limit liquidity.
Which brings us to corporate governance itself. The CEO is also the chairwoman.
Yes, that dual role. It's common in smaller companies, but it always raises potential concerns about independent oversight from the board.
But there are independent directors.
Yes, the board does include experienced independent directors, which is a positive check.
But in a microcap, potentially with insiders owning 76% and the CEO also being the chair, the effectiveness of that independent oversight becomes absolutely critical, doesn't it?
It really does. Can those independent directors truly challenge management and protect the interests of the minority public shareholders? That's a key question you have to ask.
Okay, let's synthesize this into risks. What are the main dangers facing Guardforce AI based on everything we've discussed?
We could use that SWOT framework. Strengths, long history, trusted brand in logistics, their growing retail network, their AI development efforts, the cost control shown in 24, and that decent cash pile.
Okay. Weaknesses. History of losses, stagnant overall revenue, the AI part is still small and unproven, maybe not enough R&D money for all their ambitions, and just the general risk of being a tiny microcap company.
Right. Opportunities. The potential growth in security, RaaS and AI markets in Asia-Pacific, the chance to cross-sell AI to their existing retail clients, maybe expanding geographically, and just the general trend towards automation.
And threats. Intense competition from much bigger players, economic slowdowns hitting their clients, geopolitical or regulatory risks in Asia, technology changing too fast, competing for tech talent, and importantly, those potential U.S. tariffs.
Yeah, let's zoom in on those tariffs. The sources mention concerns about tariffs anticipated in 2025, specifically impacting GFAI's robotics.
How? Well, the idea is tariffs, especially on components coming from Asia, particularly China, could directly hit their hardware costs.
So things like steel, aluminum, sensors, motors for the robots.
Exactly. If they source those from places hit by tariffs, the cost to build or buy their robots goes up.
Which isn't just about the direct cost, right? It could cause supply chain headaches, delays, shortages.
Definitely. And for their robot as a service model, where they lease the robots out, higher hardware costs could squeeze their profit margins or force them to raise prices and become less competitive.
Could this maybe push them even more towards the software side of AI.
That's a really interesting potential consequence highlighted in the sources. If tariffs make the physical hardware more expensive and problematic,
Yeah.
it might actually incentivize them to double down on the parts that aren't heavily tariff impacted, the AI software, the cloud platforms.
Because those are more scalable, less tied to physical supply chain.
Exactly. And it aligns with their stated strategy of moving towards higher margin software and services anyway. So an external threat like tariffs could maybe paradoxically reinforce their internal strategic shift towards software.
Fascinating. Pressure on hardware, potential tailwind for software.
Yeah,
That's a key dynamic to watch.
definitely. All right, let's try and wrap this all up. Conclusion time. What's the bottom line on Guardforce AI looking through that value investing lens based on these sources?
Okay, so Guardforce AI is clearly deeply in the middle of this huge, pretty challenging transformation. Quick recap. Business is shifting from stable logistics to risky but potentially high-growth AIRRs. Management cut costs effectively but faces the massive test of executing the AI strategy.
Financials show smaller losses and good cash, but no profit yet and flat revenue.
Market sentiment is mixed. Analysts are bullish, but the price action is skeptical. Ownership is unusual, very low institutional, maybe extremely high insider concentration.
And risks are significant execution failure, intense competition, external factors like those tariffs.
So is it a classic value investment based on these sources, thinking about moats, consistent profits, predictability?
Doesn't sound like it.
No. The sources frame it clearly as a speculative turnaround and growth play at this point in time.
Okay, but there are positives, right? What are the key things someone bullish might point to?
Definitely. That big drop in the net loss in 2024, the improved gross margin that shows they can manage costs, the strong cash position gives them time, runway. The CEO's ownership aligns her interests. And they do have that established base in growing Asian markets.
And the big negatives, the major risks.
The long history of losses is hard to ignore. That stagnant overall revenue is a huge hurdle. The fact that the AI business is still unproven in terms of scale and making actual profit, intense competition. Microcap risks, tariffs, talent retention. It's a long list.
So the core investment case, according to these sources, it really boils down to one thing.
It really does. It
Yeah.
hinges entirely on management successfully pulling off this incredibly complex AI pivot. They have to turn the concepts into products people actually buy, widely adopt, and do it at a scale that generates sustainable revenue growth and profitability. That's it.
And the current valuation. Price around $1.17. Price to book below 1 looks cheap on paper. Statistically, maybe, but you have to weigh that heavily against the lack of profits and the totally unproven nature of this transformation. It's only cheap if you strongly believe they will succeed in generating those future earnings. Big if.
Okay, so that brings us back to the tease from the beginning. The single most critical factor, the biggest hurdle, GFAI absolutely must overcome. The one thing to watch.
Based on everything in these sources, it has to be the successful commercialization and scaling of their AI offerings.
Meaning, just building the tech isn't enough.
Not even close. They need to prove there's real market demand for these new higher margin AI services. They need widespread adoption, generating enough revenue to finally reverse that stagnant top-line trend, cover all their operating costs, and achieve consistent net profitability. That specific outcome is the single most critical test for Guardforce AI's future.
That makes complete sense. All the strategy talk, the cost cuts, it all comes down to, can they actually sell enough profitable AI stuff to become a sustainable, growing company? That's the billion-dollar question. Well, maybe the $24 million question in this case.
Right. So thinking about this deep dive, if you, the listener, were looking at GFAI, what's the single most critical factor you track over the next year? Is it a strength, like the cash, a weakness, like the flat revenue, an opportunity, like AI growth, or a threat, like those tariffs?
For me, building directly on that critical test, I'd be laser-focused on any signs of accelerating revenue growth, specifically from the AI and RAOS segments.
It's that granular data they haven't really shared yet.
Exactly. That's the data point needed to confirm if this whole pivot is actually starting to gain real traction in the market, or if it's still just a promising idea.
That's a great focus point and a good question for you, the listener, to ponder too. Considering the potential of AI here versus the very real challenges this tiny company faces, how do you feel about the risk versus reward? Well, we hope this deep dive into Guardforce AI, drawing straight from the source material, has given you some valuable insights to think about. And remember, If you want more deep dives like this, covering specific companies using their latest data, definitely like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, do that. And members there, for just $4.99 a month, can even request their own prioritized deep dives. It's a great way to get focused analysis.
It really is.
Okay, now, the necessary bit. Please remember, this deep dive is purely for informational and analytical purposes.
Absolutely.
It is not financial or investment advice in any way. This whole discussion is based only on the source documents provided to us, and it's AI generated. We haven't done any independent checking or outside research.
And investing, especially in microcap stocks like Guardforce AI, involves significant risk. You could lose your investment.
Please always do your own thorough research, your own due diligence. Talk to a qualified financial advisor who understands your personal situation before making any investment decisions.
And never forget, past performance is absolutely no guarantee of future results.
Thanks for tuning in to this deep dive.